Your CPA is probably telling you to use standard depreciation. They're wrong. You are leaving six figures on the table by following the safe path. Most landlords just accept the 27.5-year timeline and call it a day, but the wealthiest investors in the game, they don't do that. We've analyzed portfolios worth tens of millions, and the difference between a standard investor and a strategic investor isn't how many doors they own, it's how they handle the IRS. We specialize in the tax loopholes that turn rental income into tax-free wealth. Today, I'm pulling back the curtain on the cost segregation secret. I'm going to show you how to legally accelerate your depreciation, wipe out your rental income tax for years to come, and put that cash back into your pocket to buy more property. By the end of this video, you'll know exactly how to stop overpaying the government and start scaling your portfolio faster. Let's dive in. Most landlords just accept the 27.5-year rule. It's the default, it's safe, and it's costing you a fortune. Think about it. You're taking a tiny slice of depreciation every single year, while your rental income is getting hammered by taxes right now. You're essentially giving the government an interest-free loan for 3 decades. Your CPA probably told you this is just how it's done. But how it's done isn't how the wealthiest 1% build empires. They don't wait 27 years to get their tax breaks, they want them now. Every dollar you pay in unnecessary taxes today is a dollar that isn't buying your next property. It's a dollar that isn't compounding in your portfolio. You're not just losing money, you're losing velocity. If you have a property worth $500,000 or more, the gap between standard depreciation and what you could be saving is staggering. We're talking tens of thousands, maybe hundreds of thousands of dollars in immediate tax savings. And yet you're still following the safe path, while the IRS happily collects a check that you didn't actually have to write. Here is the truth. Standard depreciation is a slow lake. It takes 27.5 years to recover the cost of your residential property. In the world of investing, that is an eternity. Your CPA isn't necessarily wrong, they're just playing it safe. But safe is costing you liquidity. The solution, cost segregation. It sounds like corporate accounting jargon, but it's actually a simple shift in perspective. Instead of treating your rental property as one single asset, we break it apart. Think about it. Does a carpet last 27.5 years? No. Does a dishwasher last nearly 3 decades? Absolutely not. Cost segregation allows you to identify and reclassify personal property assets, like cabinetry, lighting, and flooring, into shorter depreciation cycles. We're talking 5-year, 7-year, and 15-year buckets. Now here is where the magic happens: bonus depreciation. This is the real wealth builder. Bonus depreciation allows you to take a massive percentage of that accelerated depreciation in the very first year you place the property in service. Let's look at the math. Imagine you bought a rental for $500,000. Using standard depreciation, you might write off roughly $18,000 a year. Boring, slow. But with a cost segregation study, you might find that 20% of the property's value qualifies for 5-year depreciation. That's $100,000. If you use bonus depreciation, you could potentially wipe out $100,000 of taxable income in year 1. That is a 6-figure swing in cash flow that stays in your pocket, not the government's. Now, a warning. You cannot just guess these numbers on a napkin. The IRS requires a professional engineering-based study to justify these reclassifications. If you get audited and you can't produce a report, you're in trouble. This is why high-net-worth investors hire professional cost segregation firms. The cost of the study is usually a tax-deductible expense itself, and the ROI is typically astronomical. To make this work, your bookkeeping has to be flawless. You can't manage a sophisticated tax strategy with a messy shoebox of receipts. This is why I recommend using Stessa or QuickBooks Online. You need a dedicated system to track your basis and your depreciation schedules, so when tax season hits, you aren't scrambling. Now, executing a cost seg study is powerful, but you can't manage it on a napkin. You need a system. That's why I recommend Stessa for tracking your rental performance and QuickBooks Online for the heavy lifting on your bookkeeping. Both are linked in the description below. When you combine professional cost segregation with clean books, the results are life-changing. We're talking about potentially wiping out your entire tax bill for the year. That is six-figure capital you can reinvest into your next property instead of handing it to the IRS. If you want a direct referral to a certified cost segregation firm that actually delivers, check the first link in the description. Stop playing it safe and start playing it smart. Hit the like button if this saved you money and subscribe to master your passive income. I'll see you in the next video.